Barry, we've talked a lot about the U.S. economy, what the Fed may or may not do, and volatility in the U.S. markets. Of course, that does translate into Canada. So let's talk about the Canadian landscape right now, and what you're seeing, what you think the BOC Bank of Canada will do, and what Canadian investors should be thinking about.
Well, I think for Canada, I'm expecting weaker growth in Canada than the U.S., which is normal in economic downturns. I'm expecting the Bank of Canada to not necessarily cut rates more than the U.S. because rates are already quite a bit lower in the U.S. or in Canada than the U.S. But I think that the Bank of Canada could be quicker and a little more aggressive,
Hmm.
which will lead to a lower Canadian dollar. So I think U.S. dollar exposure for Canadian investors in this year will not only be add to returns, but is somewhat of a hedge because if Canadian equities go down more than U.S. because the economy is weaker, which is often historically the case, having exposure to the U.S. dollar helps hedge against that.
Hmm.
Um, and oil is a big part of the Canadian economy, energy, and oil is a big wild card for this year. I mean, it economically demand looks like it's weak and weakening for global energy markets. But then we also have heightened geopolitical events that could cause oil to spike in the middle of weak demand, which is like the worst thing that could happen for the global economy.
Hmm. How are you looking at the geopolitics right now?
Well, they're a factor. There's no question. We've got some active wars in the world, and half the world's population is holding elections this year.
Mm.
And the one thing that is constant about elections is they tend to cause volatility in markets and tend to concentrate volatility on the downside more than the upside until they're out of the way, and then you generally get rallies back.
Hmm. And when we think about the geopolitics, it's so interesting. The market just always seems to shrug it off. But so
Potentially.
that's one aspect. The other aspect, of course, to be considering right now, and it's a longer term, more of a bit of, it's a little bit more glacial. I've always said, but we are seeing some of the acute aspects of it, which is deglobalization. You're seeing new alliances around the
Right.
world. How are you interpreting that as you invest? Or again, does this all just go back to volatility, and that's how you're going to play this?
Yeah, I mean, it does. I mean, betting on volatility to me seems a pretty easy way to make money this year. But there's no question that the China US, you want to call it a Cold War or whatever you want to call it, is contributing to deglobalization. Deglobalization increases supply chain risk, tends to decrease margins and profitability, and therefore multiples in the equity market. So it's just a natural consequence of the aftermath of these zero interest rate years.
Hmm.
And it's kind of piling on to all the impacts of what happens in the global economy when interest rates go from 0 to 5%.
What's amazing to me, though, as well, Barry, and you and I have been talking probably for about 10 years now on the markets, is that we've had these zero interest rate policies for over a decade. And, we started to see the unwind of that and the volatility that occurred on the back of that. And here we are talking about the fact that central bankers around the world are likely going to have to cut in 2024. In other words, we never really got the unwind, or will we? Because I think your biggest concern is always that the next crisis would be a sovereign debt crisis, but I don't think that's going to occur if we're in fact lowering rates again and we've got the same cycle happening again. We're going to pick up that on the other side of the break.
Okay.